Most people celebrate getting a raise, believing higher income automatically leads to better financial progress and long-term financial stability. But sometimes earning more money can actually reduce how much you truly keep after taxes, benefit reductions, and hidden financial consequences. Imagine negotiating a raise after years of hard work, expecting your financial life to finally improve significantly and create new opportunities. Then, tax season arrives, and suddenly your bigger paycheck feels smaller than you ever imagined when calculating your future plans. Because raises don't only increase income, they also trigger hidden taxes, benefit reductions, and complicated financial consequences most employees never expect. Many employees never realize how the system quietly takes larger portions of their earnings as their income grows. Tax brackets, payroll taxes, and benefit limits combine together, creating outcomes that surprise workers who expected financial improvement. Your salary might increase dramatically on paper, yet the money you actually keep grows much slower. Sometimes government benefits disappear instantly once your income crosses certain eligibility thresholds. These sudden financial losses are known as benefit cliffs, and they can erase thousands of dollars overnight. For many families, a modest raise removes childcare assistance worth tens of thousands of dollars every year. Suddenly, the raise meant to improve your finances actually leaves your household worse than before. Another hidden layer appears through payroll taxes and additional Medicare contributions once income passes specific federal thresholds. Most employees never learn about these rules during salary negotiations or promotion conversations. People proudly accept raises without realizing their real purchasing power may barely improve. But the raise itself isn't the problem. The real issue is understanding how taxable income actually works. The tax system focuses on taxable income rather than the total salary your employer reports. That number can change dramatically depending on deductions, contributions, and financial planning strategies. People who understand this difference can legally reduce taxes while keeping the same salary. Retirement contributions reduce taxable income directly before taxes are calculated by the government. Health savings accounts provide another deduction, while also helping cover medical expenses efficiently. Combining multiple deductions together can significantly lower the amount of income the government taxes. Someone earning $145,000 might legally reduce taxable income much lower through deductions and planning. That shift can protect benefits while also reducing tax exposure at the same time. Over time, these strategies save thousands while building powerful long-term retirement investments. The system doesn't punish raises, it punishes workers who never learn how the rules actually operate. Once you understand taxable income, you begin noticing opportunities most employees completely miss. Financial planning becomes less about avoiding work and more about structuring income intelligently. The same salary can produce completely different financial outcomes depending on strategy. Learning how the system works turns a raise from a tax trap into a powerful financial advantage. Financial freedom isn't motivation, it's structure. If you're ready to see how the system truly works, follow for real strategy.